There is a hidden amplifier buried inside the American mortgage market, and every so often it wakes up and makes a move in interest rates far bigger than it should have been. The American market for mortgage bonds is enormous, around $9 trillion. Most of the time it sits quietly in the background, but under the right conditions, the people who own these bonds are all forced to do the same thing at the same time: sell government bonds into a falling market, which pushes interest rates up even faster. This is the story of that amplifier, why it exists, and why it can turn an ordinary bad day for bonds into a violent one. Here is why you should care even if you never buy a mortgage bond. The 10-year U.S. Treasury yield is one of the most important numbers in finance. It helps set the cost of mortgages, car loans, and borrowing for companies and governments around the world. Now, most of the time that yield moves for ordinary reasons, like inflation news or what the central bank says, but sometimes it lurches, and part of the reason is a feedback loop coming from the mortgage market. When mortgage investors are forced to hedge, they sell treasuries, and that selling can make a rate move larger and faster than the news alone would justify. So the payoff to grasp early is this: the mortgage market is not just a passive victim of interest rates. Under stress, it can reach back and shove those same interest rates around. To see how, you have to understand one strange feature of a mortgage bond. When you take out a typical American home loan, you get quite superpower. You can refinance or pay it off early whenever you like, with no penalty. That is great for you. But think about the investor on the other side who bought a bond made of thousands of mortgages. They effectively sold you an option, and they cannot control when you use it. When interest rates fall, lots of people refinance, so the investor gets their money back early, exactly when there is nothing good to reinvest it in. When rates rise, the opposite happens. Nobody refinances, everybody keeps their cheap old mortgage, and the investor is stuck holding a low-rate bond for much longer than they hoped. That lopsided deal, good outcomes taken away and bad outcomes extended, is what analysts mean by negative convexity. The bond behaves in the worst way at the worst time. Now let us run the machine. Start with interest rates rising. Because almost nobody refinances when rates go up, the mortgages in these bonds are expected to last much longer. In market language, the bond's duration extends, meaning it now behaves like a longer, more interest rate sensitive bond than it did yesterday. That is a problem for big holders who try to keep their overall interest rate risk steady, like mortgage, real estate investors, and the firms that manage these portfolios. Suddenly their risk has ballooned, and to bring it back down they have to do something quickly. The classic move is to sell treasury bonds, or to pay fixed in the interest rate swap market, which has a similar effect. But here is the twist: that very selling pushes treasury yields higher. Higher yields mean even fewer refinances, which extends mortgage duration even more, which forces even more hedging. Round and round it goes, each step feeding the next. When it really gets going, analysts call it a convexity event, a self-reinforcing spiral where the mortgage market and the treasury market shove each other in the same direction, and a normal sell-off turns into a stampede. This is not just theory. History has a few famous convexity flare-ups, and the New York Federal Reserve has written about how mortgage hedging amplified rate moves in the 1990s and in 2003, and it happened again recently. In May of 2026, a sharp jump in yields was made worse precisely because mortgage investors were rushing to hedge. Over a single week, the 10-year yield climbed about 23 basis points to nearly 4.7%. Its highest in months. At one point, a single trade to cut mortgage risk hit the market with 33,000 5-year futures contracts at once, many times the usual size. Reporting at the time noted that more than $2 trillion of mortgage bonds carried high coupons that made them especially sensitive, and that as the central bank let its own mortgage holdings run off, that convexity risk was moving back onto private hands. In other words, the amplifier is not a museum piece. It is alive. So here is the lens to keep. Mortgage convexity is a sleeping amplifier. For long stretches it does nothing, because rates are not near the levels where big groups of mortgages flip from being refinanced to being frozen. But cross one of those levels, and suddenly millions of loans change behavior together, forcing their owners to hedge in the same direction at the same moment. Against a treasury market of around $30 trillion, mortgage hedging is not the biggest force in normal times. But in a moments that matter, it can be the difference between a calm move and a disorderly one. The thing to watch is not just where rates are, but whether they are approaching the levels where the mortgage market is forced to act. That is when a quiet corner of finance briefly grabs the wheel.